Well, on a day, Australian stocks were smashed. The country's biggest bank, CBA, has clocked up the biggest ever bank profit, $9 billion after tax, a 5% rise. But along with the huge profits comes a $5 billion capital raising to meet the new capital requirements set by the regulator. We'll hear from Commonwealth Bank CEO Ian Narev shortly, but first this piece from Neil Woolridge.
It's another record-breaking $9 billion profit for Australia's biggest bank, but it could be the last in a golden era for the Big Four.
CBA's result looks good, but if you look behind the details, half on half, the earnings are actually falling on half, so it actually looks like they're in a bit of a downtrend at the moment in terms of their earnings.
Share prices of Australia's major banks have fallen between 15% and 20% from their highs in March and April. In part, investors are worried because the Big Four need to raise more than $30 billion collectively in extra capital. NAB led the charge in May, announcing a $5.5 billion rights issue, but less than half will go towards its capital buffers. Westpac and ANZ followed, and now the Commonwealth is tapping the market for $5 billion. But even after those supersized raisings, the major banks are barely halfway to their target. And it's likely they'll need a combination of asset sales, dividend reinvestment plans and further share issues to get them over the line.
We'd expect the banks to do another round of cost cutting, and as you've seen, loan rates are starting to rise a little bit on this. So if that continues, we could find that the banks achieve flat earnings per share. That's probably the best case scenario at this stage.
The other concern for shareholders is the bank's shrinking net interest margins, the difference between the interest rates they charge borrowers and what they pay depositors.
That's $2,350,000.
Over the past month, the Big Four and regional banks have taken steps to rectify that by raising interest rates on investor home loans by around 1/4 percentage point each.
It has been a tough time, but the pricing action that they have taken on investor loans is going to significantly mitigate that negative factor.
Despite this year's sell-off in bank stocks, Brett Lemessurier says there's potential upside in their share prices over the next year.
You'll have to be patient. Most of that upside will come towards the back end of that year, but I would expect the bank share prices, the major banks, to be up of the order of 10% from their current levels, if not higher.
But that will also depend in large part on the health of the economy and whether the banks can stop the recent uptick in impairment charges from becoming a deluge of bad debts.